You're tuned into Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Hormuz Patakia. We are in the festive mood. So are the markets today. What a stellar rally that we are seeing right now. It's a 150-point uptick that we are seeing. What about the markets in general? Mid-caps, they too have recovered from the lows.
In the pink of health are the markets, and you can say that with all confidence. The Nifty bank is at a record high. The Nifty is now moving in a one-way direction towards the 25,750 mark. Now 150 points higher on the index. It has crossed above that 25,700 mark for the first time since in 2025, and the Nifty bank at a record high as well. It's a 10,000 point recovery on the Nifty bank from the lows that it made in March.
Absolutely. And, you know, if we talk about individual names as well, they're just not reacting to earnings anymore. There are a lot of other factors, one of them being the markets surging in trade as we speak. Nifty FMCG, that is the top gainer in terms of sectoral movers, 1.3% higher there. We have Nifty Auto, which is contributing as well. IT not so much. After those earnings coming in from Infosys and Wipro, we do have the metal index, which is lower as well. But all in all, not much to complain for the bulls today, at least, with Nifty Bank surging to those levels. But Hormuz, you have some market movers on your radar. Tell us more about it. Which are the stocks there?
No reason to complain whatsoever. And the broader markets are painting a similar picture now that they have started to recover from the lows. It started with Aztec Life Sciences. The stock has now snapped a 4-day losing streak today. And it's been an underperformer so far. It's gained only thrice in the last 10 trading sessions. But it is the biggest single-day gain that the stock has seen in 2025, this 14.5% up move. The volumes that you have seen today are already the highest since June. They will cross them very soon as well, so maybe we'll have a different picture come afternoon. 6.5 lakh shares have already traded on Aztec Life today, and you take a look at the 20-day average, that's only 2,300 shares. Now the stock has also moved above its 50-day moving average of 821 and the 200-day moving average at 824. The next level to watch is going to be the 100 DMA, which is at 836. Share India Securities, we spoke about this yesterday, we spoke about this morning as well, is another 9% on this stock today. It's up 42% now in the last 3 sessions, and today's volumes in the first couple of hours have already crossed yesterday's volumes. We've had 1.2 crore shares that have been traded. The 20-day average is just 4.5 lakh shares, and we spoke about that 200-day moving average yesterday. It has now broken above that level and is sustaining above it. The extent of the underperformance has been such that despite this 42% gain in the last 3 sessions, the stock is still down 40% in 2025. And the last one on the list today is Whirlpool. Consumer durable names are making a move in the festive season, but today is the third straight day of gains for the stock. It's up 16% now in the last 3 sessions, and the volumes this week have seen an increase every single day. And today, of course, is the highest that you have seen in the week at 12 lakh shares being traded. The 20-day average is less than 80,000 shares. And despite this up move, as also features among the underperformers, does Whirlpool is down 28% in 2025 amidst all of these stake sale rumors from the promoters.
Oh, yes, some interesting moves there. Thank you so much, Hormuz, for bringing that list for us. And, you know, IT continues to take the center stage, right? LTI Mindtree, that's one stock on our radar, reported a strong set of Q2 earnings. The EBIT margin was up 160 basis points. Our colleague Reema caught up with Venu Lambu, who is the Chief Executive Officer and Managing Director of the company, on their Q2 results and the outlook. Listen into what he had to say.
Yes, it's been a strong quarter for us. We reported 2.3% on dollar terms and 2.4% on constant currency. I think when we spoke last time, I guess at the end of the Q1 results, I did share my plan that we intend to reach nearer to the double digit sometime in the second half of the year. And I think, the results of second quarter essentially, pushes us in that direction. So the plan is intact. We have a good pipeline, and we're executing towards that plan. So I would say somewhere in second half, most likely in Q4.
But beyond the second half of the year, do you think, say, FY27 onwards, on an aggregate basis, the company can hit double-digit revenue growth in its stride? I mean, is that the direction?
Look, we always want to grow faster than the industry, but I guess it's too early to talk about FY27. Probably when I talk to you sometime in January, I'll be able to give you a more directional view about the FY27. Right at the moment, we are all focused to make sure that the second half is has the same growth momentum. the profitable momentum, both on, we grow both on the revenue and profits and, meet our goals.
So under the Fit for Future initiative to expand margins, what's been the extent of margin improvement and what is the headroom?
Well, I think when we spoke last time, I did mention about, achieving 100 basis points over a couple of quarters. And if you see our results this quarter, we are ahead of the plan, right? So, we're sort of already meeting the commitment that we made. But having said that, as I mentioned in our earnings call yesterday, we do see that there is an opportunity to sustain this margin and also to improve it as we get into the Q3. So, I don't want to put a specific number to it, but, you can expect that we will expand margin in Q3 as well.
Your salary hikes are now going to be implemented in two phases. Half of them in Q4 and the balance in Q1, FY27. Is that correct? And again, give us the margin implications. You talk about sustaining and improving margins, but some guidepost in terms of the goalpost would be helpful.
Well, we don't give a specific outlook, but as I said, the commitment of expanding 100 basis points at the back of Q1, I think that we are ahead of the plan. And I still see a scope we can get better, both on the cost side and the kind of deals that we pick up that will help us to expand the margin in the second half of the year. Now, when it comes to the wage hike, look, I think it's important to put a context to this approach. The context is that I do believe that in the new normal, are we going to see one increment one day for all of the employees? Probably not. I think we will see an increment to be done over, more than once in a year or a couple of quarters. And in some cases, you actually, might do it throughout the year in different phases for different teams and the skill sets that we identify as important. But I think, if I just put it in the larger context of the transformation that the industry is going through, and most importantly, our company, we want to take our employees as part of that transformation journey. And, hence, we feel that once we meet those milestones, we'll reset into the new normal and how we manage the wage hikes going forward. So we announced the wage hike effective from January 1st. So we'll start giving it in phases between January and April.
Your deal wins were $1.6 billion in the quarter gone by. Can you break down how much was net new versus renewals?
Well, we don't call that out, but as you would see, most of the renewals also come with a new scope, right? So it's not a like-to-like renewal, both in terms of scope and in terms of price point. So most of the renewals have an incremental business that gets added to that.
Are there any large or mega deals that you're likely to close in the second half of the year that can materially lift growth? I mean, are you close to signing any large deals?
No, nothing that I can announce, but I can say that our pipeline is pretty strong. Right. Last quarter, when I know that I was about to sign in a few weeks and a month's time, I took a chance of sharing that. But as we enter into the, sort of a Thanksgiving holiday and Christmas around November and December, though there are deals which are at a very interesting phase, in the sales cycle, but I just don't want to put a timeline to say that, can we sign that in Q3 or so. But I can just assure that we have a good pipeline in large deals and we are focused in closing them.
How are the Q3 furloughs likely to be? Similar to last year or more, given the uncertainty in the environment and the fact that the tariff deal has still not been struck?
Well, at the moment, we see the furloughs to be the same as last year. There are no different variations that we see. So it's the same as last year.
Yeah. How many employees did you send, Venu, on H-1B visa this year, FY25 and last year? And what is the plan now with the hike?
Sure. It's a very small number, to be honest. It's in hundreds. This year is about 250, 300 that we had, employees moving on to the H-1B. Over the last couple of years, our dependency on H-1B has actually reduced. In US, it's about 50% of our employees are on H-1B and the rest of them are on visa independent category. We have a plan in place to strengthen our nearshore delivery. Our local hiring is getting strengthened. And I also see clients talking to us to increase offshore. They're also talking to us, to to leverage a good mix of nearshore, on-site, and offshore. So I think the business will settle to its new normal. I don't see any material impact with regard to the H-1B topic is concerned.
But 50% of the US employees are still on H-1B visa. Would you like to bring it down? Because there are margin implications of paying that 100,000 visa fee.
Well, the H-1B visa fee is for the new applicants, the employees who are over there. We will work through them for a period of time, along with our customers, as and when the point of renewal comes.
The management of LTI Mindtree among the top earnings reactions of the day. The stock not doing enough as of now, but still trading above the flat line. The Nifty 160 points higher now, well above the mark of 25,700. We take a short break. We focus on the crypto markets on the other side with Manisha Gupta.
Sense Crypto Corner, powered by CoinDCX.
In Crypto Corner today, we are talking about crypto staking. I mean, this is an important one. Remember, you always do buy cryptos, but how do you put that to use while you're sleeping? This is something that you can do via crypto staking here. So crypto staking is a process of locking up some part of your cryptocurrency to support operations of proof of stake blockchain network. This is one part of it. Well, proof of stake blockchain network, what is that? Proof of stake blockchain network uses a consensus mechanism. What happens in this is that you have your moves have to be validated, and this is done by validators here. Interestingly, this method is more energy efficient. It also replaces complex computations with the commitment of staked coins therein. Also examples, the major ones, blockchain networks which do use that are Polkadot, Avalanche and Cardano. Now, what are the benefits and how does crypto staking really work? So as I said, you already have bought cryptocurrencies. While the prices rise, you are making gains there. But when they're not, what you can do is you can put this cryptocurrency to use, and some certain amount of this can be put out, and this will earn you, this participation will earn you passive income there. Now, this is used to help validate and process transactions on the network, as we spoke about. For your participation in securing this, this help in newly minted coins or network fees is what you get as you stake your cryptocurrency. So as I said, a passive income is what you generate once you stake your cryptocurrencies there. It's a core component also when it comes to at POS, which is proof of stake, bitcoins or blockchains, that is, which are considered as more energy. Various benefits, as I told you, it earns you passive income, it supports the network, and it is a simple way of participating, being part of the blockchain network, and you don't really have to do big computations or have big computers or get into difficult mining therein. You can be part of network and earn money as reward and fees being a part of this.
Okay, all right. Thank you for explaining that to us, Manisha.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Right, thank you so much for explaining that to us, Manisha. But let's move on and talk about stock markets now. Rossari Biotech, that is the one on our radar, reported their Q2 earnings with revenue and EBITDA beating estimates. Sunil Chari, co-founder and managing director of the company, is joining us now to explain what happened in the quarter gone by and the outlook going forward. Mr. Chari, good morning. Thank you so much for joining in. And festive greetings to you and everyone at Rossari Biotech as well. Let's talk about the business now, because this time around you said that growth in institutional and B2C business remain muted. What is happening here exactly? Do you expect some recovery that could come by? And what is it as a percentage of overall business?
The B2C or the semi B2C, which is the institutional cleaning chemicals and the pet business which we have, the pet care, grooming and food which we have. The EBITDA has the losses have reduced. We had loss of about 3.8 crores now in the Buzil Rossari business, and we continue to focus on getting this to EBITDA neutral by the end of this year. We cut down on products where we had lesser margins, and we did not focus on growing the business. Rather, we focus on making it EBITDA neutral. But on the good side is that our B2B business, which is our main business, we have a 15% EBITDA. We have a 14% growth in the first half or the first half of last year. Our EBITDA is now the highest. We had the highest quarterly sales and EBITDA ever in our history. US markets did not, and the exports did not do as well. Although we had 28% of our sales as export, which is again highest, but we expected much more. But September was a little subdued, and otherwise we could have done still better.
Mr. Chari, good morning. Thank you for joining in. You mentioned September was a little subdued, but have things picked up going into October? That's part one. And since you mentioned exports, the growth that you saw in the second quarter, which was around 36%, does that number sustain for the full year as well?
We are hoping that this will sustain for the full year. Our efforts are there. And I think the tentativeness which is there, especially in the Americas, with regard to placing orders, should go away in this quarter. So we are hoping for the best. The domestic market seems to have picked up a little, and this could also be something which we have to cheer about.
Okay, that was going to be my next question, Mr. Chari. Overall revenue growth has been 9% in quarter two, out of which exports we have seen have grown around 36%. How much was the growth overall in the domestic markets? I'm talking about every business, B2C, B2B, institutional. And what kind of volume growth did you see in the quarter gone by?
See, if you compare year on year, the first half, we have more than 20% growth in volumes over corresponding year, corresponding period in the last year. So this volume growth is based because the pricing of the products have gone down. The raw material prices have gone down, and consequently, with the pass-through, we also have the finished goods pricing coming down, and the oversupply in the Chinese market, especially in the petrochemical derivatives, is putting pressure all over the world for this. And then the tariffs and the uncertainties, and Europe also is going through its own set of problems. So we are also focusing on the Far East and the Southeast Asia, for growing our exports. But the MENA region could be another area which we should focus for the future.
So you're going to shift your focuses towards Southeast Asia and all other such economies to grow your exports, as you were mentioning. But has there been any positive response from any potential clients that you have reached out to within these geographies, Mr. Chari?
Yes. We have started a lot of new clients, both in MENA and the Far East area in the last quarter. And we continue to see uptrend in this also. So we divide our eggs in different baskets. But the US and Europe will continue to be a majority of our exports. That is what we believe in the future.
So, this time all segments have seen good growth, be it your textile specialty chemicals, animal health and nutrition. Those were some of the segments which were seeing some pressure. Can we say for good those pressures are done with, and now you will continue to see the growth that you saw in this quarter? And secondly, what was the growth in Unitop's business? There were some pressures with respect to supply chain because it's largely agrochem focused. Is that done away with as well?
Traditionally, the third quarter we get business from the south of India, and I think we should. The monsoons have been pretty, good, not bad there. We had a lot of issues with, monsoon in Punjab and north areas, and we think, the next year we should have pressure there because with the floods there is a lot of sand which comes and settle on the ground. But also a lot of our agrochemical customers export to the Americas. They will feel the pressure, and our textile industry especially is going to be in a trouble this quarter, and if the tariff situation does not improve, because the home textile, which is one of our bigger markets, the focus is US for our customers, and all of them are in big pressure. So textile, we don't see the growth sustaining definitely, but home personal care and performance chemicals and animal health and nutrition is something which we think should do well.
Mr. Chari, once the second phase of your ethosylation capacity comes on stream in the third quarter and the other capacity expansions that already have come on stream, what does that do to your overall financials in FY27? What are the kind of improvements that you are envisaging then?
See, for example, now this month we have had issues with the supply of ethylene oxide because the Dahej plant had an unexpected shutdown of Reliance for EO, and we have shortage of EO this month. So this shortage of EO should go away, hopefully, in the second half of the calendar year of next year, or maybe the second half of the financial year of the next year. Till then, we are maintaining the business and trying to grow the non-ethoxylate business, which is basically the esters and polymers, and also the animal nutrition segment. Once we get the EO, we have the markets, and I think we should grow well.
All right, so we'll watch out for when you get the supply easily, and that is something that would serve the business output as well. Thank you so much, Mr. Chari, for joining in today with your thoughts and insights on the outlook going forward. That's Rossari Biotech, but it's time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. It's a good time to get all the trends from the FNO space. Mangalam Malu is joining us now. Mangalam?
It's a sparkling looking screen. If you look at, the frontline indices, the Nifty well above that 24,750 mark, the Nifty bank at a record high, the Nifty bank at Nifty itself at a 52-week high, all of that doing well. But in the mid-cap index, the mid-cap index isn't participating in today's rally, but nothing really to worry about out there as well, because that too has been doing well in the earlier parts of the week. If you look at the advanced decline, it's split right down the middle. In fact, we have a little more number of stocks which are declining than the number of stocks which are advancing. But two things that I'm watching out for that may prevent a further melt-up from current levels. First part is the India VIX. Even as the market's moving higher, you would want the VIX to come lower, but that's not happened. In fact, the India VIX has seen a big surge, so the chart of the India VIX comes up for you. The second part that I'm looking at is that the Nifty put-call ratio has moved higher as well. So if you look at the stocks that are gaining, you do have the ones which have been underperforming, which are seeing some traction. So the likes of Asian Paints, HUL, Bharti Airtel, the consumption theme ahead of the festive season doing extremely well. And a large part of the short move, the move has been led by short covering in a couple of these calls. 25,400 call, 25,450 call, all of them have come in for a fair amount of short covering. On the way down, we have seen 25,700 and 25,600 put see a fair amount of writing as well. Typically, when this happens, it is something that takes the PCR higher. So the PCR, the put call ratio, has now moved to the higher end of the range, 1.44 versus 1.36. Typically, at these levels, we see a bit of consolidation and a cool off, after which the market moves higher. So that's something I'm watching out for. A lot of short positions added in a few IT names, Infosys, Wipro, both of them under pressure today, and a lot of long positions added in, again, consumption-related names. Gold, Muthoot Fincorp at, because of gold being at a record high, PG Electroplast, again, electronics doing a lot better, so maybe one of those plays out there. Those two counters fairly well bid in today's trading session. Market looking sparkling. How far the sparkle goes is something that we'll have to watch out for, because the India VIX is higher and so is the put-call ratio.
As should be the case, right? It's Diwali. The screen has to sparkle, so does the markets. And so are you, Mangalam, sparkling.
Thank you.
So take a short break.
You have Patakia in your name, so there's a Patakia in your name.
Who would have thought that? Seriously.
Okay. Take a short break here on Trading Hour. And we're back with more on the other side. S&P Global Ratings is Neil Gopalakrishnan joins us on the other side. We put the spotlight on Indian corporates. Stay tuned. Welcome back. Now, as India gears to scale its economic growth, all eyes are on Indian corporates. Now, in their recent report, S&P Global Ratings say that they see parallels between India Inc. and their Chinese corporates counterparts of the early 2000s. Now, they anticipate top Indian corporates to double their spending and capex over the next 5 years. Neil Gopalakrishnan, who is the director of corporate ratings at S&P Global Ratings, joins us now. Mr. Gopalakrishnan, firstly, thank you so much for joining us today. Festive greetings to you and your team as well. It was a very interesting report that you've put out. You're drawing parallels for India Inc. to their Chinese counterparts. If you could summarize those parallels for us, what are the kind of parallels that you are seeing for Indian corporates going forward?
Sure. Firstly, thank you for having me in the studio. And it's a very festive atmosphere here. Nice to be with you at this time. So yeah, we have been positive on the outlook for Indian corporates, the growth potential, and also the balance sheet health. And we have reiterated this message a number of times. So this report was actually building on that, and we drew on some lessons that Chinese corporates experienced during their period of peak growth in the 2000s. And we compared that with what Indian companies are going through now. And we saw a number of parallels. Of course, there are differences as well, but since you asked about the parallels, the most common similarities we found were from a perspective of government policies which are supporting corporate growth, the promotion of policies in order to increase self-sufficiency, export potential, building domestic capability, and also on the infrastructure side, where the government is focusing on building infrastructure, reducing logistic inefficiencies, and thereby creating an environment where corporates can grow and become stronger.
You know, you mentioned in your report how logistics cost has gone down as a percentage of GDP. And these are smaller things, but they make a big difference on overall GDP as well. But when you said there are differences as well, we need to talk about that as well, right? Because we've seen the way Chinese economy has grown versus how India has grown. Of course, it's growing at a good pace. But what more needs to be done, which should be parallel to Chinese counterparts? What are some aspects that you saw is not happening in India?
So some of the similarities that I talked about, infrastructure development, the setting up of industrial clusters, special economic zones, these really helped Chinese companies grow in the 2000s.
Yeah.
And as we commonly say, they became a factory for the world.
Yes.
But a big change happened around the 2010s when Chinese corporates moved up the value chain. And this they did by investing heavily in technology, innovation, and by increasing spend in R&D. I would say in India, there are two big challenges now. One is on the technology side. We know corporates are not spending enough on R&D. So there needs to be more focused spending on R&D. And whatever spend there is today is quite fragmented. And this spend on technology is important from a perspective of strengthening supply chains, which is one of the reasons Chinese corporates became so competitive. The second challenge is in India is execution. Things are improving, but implementation, particularly greenfield projects, it remains a challenge. Issues around land acquisition and so on. And this also has implications for FDI inflow. So I think these would be some of the areas where things, if they improve further, would be really positive for corporate growth.
So is the lack of availability of skilled labor a challenge as well for India Inc. to execute their growth plans going forward?
I wouldn't say that. As we all know, there is a lot of talent in this country. So there is no shortage from a skills perspective per se. But if you look at specific areas like say R&D, for example, I think that is where probably there are skills gap. And maybe the incentives, we now have some design-linked incentives and so on to promote the R&D side of things. But I think that together with skills where greater collaboration between, say, universities, the public sector and the private sector, those could really make a big difference in the future.
What about financing? Because, you know, there's a difference. There's been a difference in debt levels as well for both the economies. How do we go ahead and finance the R&D spends that you're talking about, the technology spends that we are talking about? I think we are internally sufficient for that?
I think you raised an excellent point. In fact, one of the differences we drew between China and India was the involvement of the state, where the Chinese government provided significant direct financial support to corporates. In India, that's more limited, but offsetting that is the fact that corporates have plenty of funding access today. So financing is not a constraint on their ability to grow. Specifically on R&D, the government itself is coming up with plans where they are investing in in R&D, and that has to be supplemented by the corporates. It'll probably happen, and we are seeing that. And as I said, there are incentives, but incentives alone will not move the needle. It needs to be a concerted effort, and at least on the technology side of things, we think it might take a few years, but things are getting there.
One interesting point that you mentioned in your note is that they'll be less reliant on exports, the Indian corporates. There are still a lot of export-heavy sectors in India. What more should be done to offset that or to turn those export-heavy sectors into domestic-oriented sectors? And if that happens, what kind of a runway can these expect in terms of growth?
Right. Good question again. And again, if we draw a parallel with China, in the early 2000s, interestingly, the Chinese domestic market was comparatively small relative to what India's domestic market is today. So the growth largely came from exports. Whereas in India, domestic growth is very strong. And in a number of sectors, we still import to meet demand. If we take the steel industry as an example, companies have significant growth plans, but the demand is growing as well that we still think it will predominantly be servicing the domestic industry. So to be able to export, two things. One, they'll have to grow even more aggressively. Yes. But in doing that, you also need to be mindful that India's own growth could have implications for the regional demand-supply balance. So that could affect profitability. And when China was growing, we say China didn't have to compete with China. But when India is growing, global competition is so high that you'll have to keep the global demand-supply in mind.
We are in a different we are in a different era right now. We are seeing a lot of macro changes at global level, at India level as well. But thank you so much for joining us today with your insights and this very interesting report where we could delve into what parallels we are drawing with China and what growth parameters we would look at going forward as well. It was a pleasure having you. With that, we'll slip into a short break. When we come back, management of South Indian Bank will join us to discuss their Q2 numbers and more. Stay tuned for that conversation. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's get to our earnings corner and talk about South Indian Bank. PR Seshadri, who is the MD at South Indian Bank, is joining us now to talk about their earnings that they reported yesterday. Mr. Seshadri, good morning. Thank you so much for joining in, and festive greetings to you and everyone at the bank as well. Let's talk about loan growth, right? We are talking about the cuts that came by, the festive season cheer that came by as well. What's the sense? Earlier, you mentioned a 12% growth that could come by. In the quarter gone by, it's a 10% growth. So do you stick to your loan growth targets and the deposit growth guidance as well of 10%?
Morning and festive greetings to all your viewers. Thank you very much for having me on this show. We are sticking with our growth targets. We think by the time the year is done, we should have more than 12% growth in our assets. We've had an extraordinarily good first half in terms of deposit growth. Our savings deposits grew 10%, current accounts grew 11%, retail time deposits grew 11%. So very strong momentum, both on the asset side as well as on the deposit side.
Mr. Seshadri, good morning. Thank you for joining in, and festive greetings to you and your team. What do you attribute this drop that you've seen in your interest income this quarter? And going forward, do you see this just as a one-off and things to improve in the second half?
So I think we've hit a trough in terms of net interest margin. This is essentially because we passed on the RBI rate cuts to all our customers at the beginning of the last quarter. So that's the full effect is flowing through for us in this quarter. We see net interest margins rising from here on. And in fact, the information that we do have internally is indicative of that. So I think this is just the bottom of the net interest margin ladder, and going forward, it's going to be much better. And the reason for this is that we have a large corporate book. Approximately 40% of our balance sheet is linked to external benchmarks, and we do have a fairly substantial quantum of very short-term assets where the rates in the market, given the fact that there was very substantial liquidity available, the rates actually dropped more than the repo rate change. So consequently, we were impacted by that. And from our point of view, this quarter, we've been able to change the asset mix quite substantially. And that we are feeling pretty good about, actually.
So how much would that number be? You're saying it's going to be higher than current levels. It was around 3% in first quarter, 2.8% right now. Do you maintain that 3% mark or maybe do better than that in this year?
So I think we should exit this year at back to about 300 basis points. We started the last quarter, we were at 3.03. We are now at 2.8. We think that we can exit the year at 3.03, actually.
Okay.
Sorry.
Mr. Seshadri, what about credit costs? Your credit costs were down this quarter, the calculated credit costs. Your provisions were down as well. Does that trend sustain? Were there higher write-offs this quarter?
They were not. Write-offs were similar to what we had the prior year. Just give me a minute, sir. The slippages came in at 21 basis points. Prior quarter was at 20 basis points. So we are our portfolio is in excellent health. And given that our provision coverage ratios had hit north of 90%, at this point in time, there was moderation that was required in the quantum of provisioning, which is why credit costs are down to where they are right now. And we think that will continue as we go forward.
Okay, and what about ROA? Do you see any downside risk to it? What's the outlook going forward?
We think ROAs will continue to be north of 1%, which is where we are at this point. And as the interest rate regime shifts for us, and as the retail and MSME loan book continues to grow, we expect ROAs to widen. I'd hesitate to give a target in the immediate future for that. But having said that, we think that the 1% ROA is something that we are reasonably confident that we should be able to deliver.
And what about asset quality, Mr. Seshadri? It was fairly okay this time around. There was some moderation that you saw from the June quarter. But for the second half, as you go into the new year, do you see that trend continuing? Do you see further moderation in asset quality, bringing gross NPAs down to around 2.5% levels?
Gross NPAs will drop. As of this moment, the quantum of provisions that we are holding are very substantial. At some point in time, the board will have to decide, what kind of write-offs to take, and consequently, gross NPAs will drop. The slippages are quite low. Our SMA2, is at 30 basis points, and between SMA 1 and 2, we are significantly lower than 100 basis points. So that gives us reasonable comfort as we go forward, and we do expect that the NPA numbers will trend in the right direction as we go forward.
Mr. Seshadri, thank you so much for sparing time and joining us. Festive greetings to you once again, and looking forward to having you more often on the platform. And the management there of South Indian Bank after their quarterly performance. Take a short break, get you more on the markets on the other side. Stay tuned. Welcome back. Now, investment buying has outpaced emotional purchases, signaling a shift in consumer behavior. And who better than Manisha Gupta to bring in a special report from Zaveri Bazaar on the eve of Dhanteras on the festive jewellery purchase. Stay tuned.
Let's also get a sense on how the gold jewellery sales are doing in Zaveri Bazaar during this Zaveri Bazaar festival here. Joining us to talk about that is Anil Jain, our Pukra Jewellers, and Mr. Kamlesh Jain is SK Gold. Thank you, gentlemen, so much for joining in. Anil, what is your sense, first of all, with the gold prices all-time high, 60% of gains in this year? Are you looking at a bit of a dent in buying, or do you think people are still attracted towards gold?
People have got now more frenzy, and it's like catching up. They all want to cash in on the daily basis rise, and make quick money. The investment buying is like exorbitant, but the emotional buying is a little down.
I think so. This is the highest gold sale ever I have seen in my career from last 32 years. People are buying because this is the safest metal.
As compared to last year, Mr. Jain, what is your anticipation? Are we looking at a bit of a decline in volumes? And if yes, then how much?
I think so. From last year, my business has grown approx 50% more.
So there's no decline for you?
No, it's not decline.
But are people buying 22 carats, 18 carats? What is it that people are investing in?
People are more buying 22 carats and the investors are buying 24 carats. But major people are buying jewelry.
Anil, is it about lightweight jewelry or is it still bridals that's working for you?
The more the prices, the quantum will go down. So lightweight and light caratage also will come in the near future. It will be a new norm now. 22 carat will wane off and 18 will be then setting in, maybe 9, maybe 12. Anything 12 carat also might catch up.
Thank you so much for joining in and giving us a sense on what really is happening here.
All right, glittering. That's what gold is looking like right now. Wishing all of you also a very, very happy and prosperous Diwali. With that, we'll wrap on Trading Hour. But stay tuned. Halftime report takes all the market action ahead.